Welcome to our webinar on personal investing. My name is Duncan Campbell, and I'm founder and CEO of Island Equity Systems. Today, I'm going to give you a preview of our exciting investment system, and then I'm going to invite your questions. You will be able to submit questions online during the presentation, and I'll address them in order at the end. So let's begin. We had four major goals when we created our personal investing system. First, we wanted to create returns of over 2% per month, which would create annual returns of over 24% per year. Second, we wanted to allow the personal investor to operate the system themselves. This would eliminate those expensive mutual fund fees. Third, we wanted to minimize the time the personal investor would need to spend managing the system. And fourth, the system had to be easy to use, even by novice investors. You can judge for yourself, but we were excited to say that we believe we accomplished all of our goals. Before we look at our system in more detail, let's understand a few key points about the overall market. I am not going to bore you with a detailed market study, but there are four things about the market that you must understand. Number one, mutual funds are very big and very powerful. In the US alone, they are over $17 trillion to invest through over 7,000 funds. They are the market. Second, when it comes to the market, the phrase, "a rising tide raises all boats," applies. In an up market, 7 of 10 stocks rise. In a down market, 8 of 10 fall. You must go with the market, not against it. Third, with over 7,000 fund managers acting independently, you can't predict future market direction, at least not with any accuracy. So don't predict, instead react. And our fourth point is very important. Mutual funds basically have too much money. It means that they can't move in and out of the market with ease for fear of skewing prices. We use that to our advantage. That's it. Only four things that really matter in the market. Now let's look at our system in more detail. So if funds can't trade properly, why doesn't the personal investor win more? Well, funds have vast research resources, but that's only part of the story. The problem is that the personal investor is plagued by two Achilles heels. The twin emotions, fear and greed, destroy the personal investor's advantage. When a stock is rising, greed keeps the investor from taking good profits. When a stock is falling, fear freezes the investor and they watch the price drop like a rock. Fund managers avoid these traps by always setting upside sell targets and downside stop loss exits. What the personal investor needs is this sort of discipline. Let's look at our system now and see how that's accomplished. Ours is what I like to call a mirrored trading system. Simply, that means everyone follows or mirrors my trading. The buys, the sells, the market exits, everything. So to start, I give you 10 stocks. They are carefully selected for their rapid growth potential. You take your investment capital and divide it into 10 equal amounts. You will invest equal dollars in each of 10 stocks, different share amounts, but equal dollars. At a predetermined date and time, say tomorrow at 1 p.m. Eastern Standard Time, everyone buys their 10 stocks. Using the master portfolio buy prices, everyone sets automatic sell orders at 10% above the buy-in. If the stock price rises by 10% or more, the sell order will automatically process for you. Now you've solved the problem of greed. The same is done on the downside. Again, using the master portfolio prices, everyone sets automatic sell orders 12.5% below the buy-in price. The 12.5% gets adjusted in less volatile markets, but most importantly, it conquers fear. Now for our simple trading rules. We are always looking to take profits whenever we can. As you'll remember, our stock selections aim at stocks ready for rapid price movement. Our 2-win rule targets big price jumps. When a stock advances over 10%, it is sold, and the money stays in cash. If a second stock advances 10%, it too is sold, and the other 8 stocks are sold as well. This ends that portfolio, and we start again with new stocks. That's the 2-win rule. But we've learned that it's also lucrative to take profits from overall portfolio advances. So we also have a 2.5% rule for the portfolio. Right? If at the end of the day, a portfolio is up plus 2.5% or more, the entire portfolio is sold. We would then start over with a new portfolio. To protect the downside and avoid fear, we have a downside exit plan. Sorry about that. Called the negative 2.5% portfolio rule. Here, we sell a portfolio if it's down 2.5% or more at the end of a day. Finally, we have a plan for stagnant portfolios. Our stock selection is supposed to pick stocks that will advance very soon. If after 20 trading days, we haven't closed out a portfolio, we close it anyway. It's just a stagnant portfolio. The good news is that we rarely have to impose this rule. Those are all our individual stock and portfolio trading rules. We also have a series of market entry and exit rules. They are administered by IES, but a few highlights are useful. Think of a traffic light with 3 available colors. We enter the market under green light conditions. A green market has rising trend and minimum volatility. When market conditions turn to yellow, we become cautious. A yellow market is a sideways struggling trend and more volatility. We will continue to trade an existing portfolio, but we won't enter a new one into a yellow market. A red market is one that's falling, usually rapidly. It's a market in correction. We automatically exit these markets and don't re-enter until a green light market conditions return. I'm often asked, how do you find the amazing stocks that we invest in? Well, that's our secret sauce. We've developed complex algorithms that identify those stocks that are currently have an excellent chance of advancing 10% or more near term. We rank those and take the best 10. Right now, you are probably saying, how will I ever remember all these rules? Well, they'll become second nature after a while, but as a backup, we always email alerts to our subscribers. Whenever a trade happens, you'll never miss a trade. So that's it for trading rules. Now let's look at the returns that they produce. Before we do, I must point out that past returns do not guarantee future results. Having said that, we are very proud of ours and think you'll find them interesting. We'll start with annual returns back in 2016. We completed and rolled out our trading system in early 2016. That year, we enjoyed excellent market conditions, and we rode those to a spectacular 31% investment return. We were excited. In 2017, we again enjoyed excellent market conditions and also benefited from a few system improvements that we made, all of which helped us achieve 35% returns for that year. Again, marvelous returns, and they really had us excited now. In 2018, we suffered from poor market conditions. The first quarter was mostly a yellow light volatile market, and the last quarter ended in red light correction mode. We still made a 13% return. We still made a 13% return, but it showed us the importance of market conditions. In 2019, market conditions were poor and volatile in the third and fourth quarters. A lot of this was caused by the bitterly contested US presidential election run-up. And we went in and out of red and yellow markets frequently. In the end, we saw returns drop to 7%, still the mutual fund average. In 2020, we regained our form. In spite of the coronavirus crash in the first quarter and the volatility of the presidential election in the third, we still registered 39% returns. And again, in part because of continued investment system improvements. We followed that up with spectacular 14% Q-run returns in 2021. That's 56% annualized, quite amazing. But perhaps an even better way to look at system returns are on a quarterly basis. Let me point out some highlights from this quarterly return chart. First, note that in 17 of 21 quarters, or 81%, we had positive returns. Second, in only 3 of 21 quarters, or 14%, did we have losses, and then by only 1% twice, and once at 3%. Third, we made 5% or better in 14 of 21 quarters. The significance of 5% is that annualized, it's a 20% return. We did that in 67% of the quarters. And finally, what I call the bounce back factor. Notice that when we suffered a poor quarter, or in one case, 3 in a row, we always followed these with bounce back above average quarters. It proved that our system was resilient. A note on commissions. Our system trades a lot. We run through 17 or more portfolios in a year. When you consider buying and selling 10 stocks at a time, that's over 340 trades. You can't afford to have a full service brokerage account at $5 or $6 a trade. Today, all the brokerage houses have discount brokerage available for anywhere from free to $2 a trade. You need one of those. Don't worry, our welcome package has 5 brokerage suggestions for you. And finally, let's talk about risk. I warn you that my assertions are going to seem laughable. So here goes. Our system is comparatively low risk as compared to most investment products. I really believe that statement and I'm going to give you 6 reasons why. First, we only recommend stock picks that are the best of the best. They have fabulous balance sheets, great earnings, and are sought after by all of the fund managers. Second is what I call the fund safety net. The stocks that we buy are in very high demand. When one fund manager sells, causing the price to fall, others are waiting for an opportunity to buy at a lower price. So a stock that falls one day tends to recover the next. Third, our portfolios are naturally diversified. We don't buy single stocks. We only buy 10 at once. A loser has only a 10% effect on the portfolio. Diversification lowers risk. And fourth, because of the way our system operates, we are actually out of the market for a significant amount of time. If we sell a portfolio midday Tuesday, we don't re-enter until Wednesday noon earliest. If a negative market event happens in the interim, we avoid it or reevaluate our position. Less market time reduces risk. Fifth, our portfolios only last 1 month or less. This eliminates many short-term variable changes that hurt performance. For example, one company suddenly has environmental problems, which takes down a whole industry, takes it out of favor. A government suddenly announces new regulations and taxes. Bad weather grounds planes and craters airline stocks. We often avoid these new variables by trading very short term. Finally, we avoid earnings risk. All public companies publish earnings reports quarterly. Unexpected poor earnings craters stock prices. But because we trade short term, we never select a stock that has an earnings report within our 20-day trading window. Potential risk avoided. So let's summarize some key system points. Our trading system avoids the 2 Achilles heels of the personal investor: fear and greed. When stock prices rise, investors get greedy and don't take profits. We take 10% and move on. When stocks fall, investors are gripped with fear and inaction. We minimize our losses and move on. We take advantages of the fund weaknesses. Their size means they can't trade quickly and effectively. We use that weakness to our advantage. Our advantages allow us to take profits often. This results in superior returns. When returns are subpar due to market forces, returns tend to bounce back strong in subsequent quarters. Our system allows us to avoid most poor markets and profit from the good ones. We only invest in high demand blue chip stocks. The demand increases stock prices and acts as a downside safety net. Our system is easy to understand and use. You don't need to be a market guru. That's my job. Our system minimizes the time spent on managing your investments. Minutes a day is all you need. You can spend more, but you don't need to. And finally, by booking your old trades online, you can eliminate those fund fees that can reach 2%. Further, you are in control of your investments. That ends the formal part of our presentation. I want to thank you for your time and attention. Now let's open up the floor to some questions. Just forward them to your moderator, and I'll do my best to answer them. Somebody must have a question. That wasn't that straightforward. Oh, here's one here. The question is, why do you take only 10% profit upside, but accept 12.5% downside? That's an excellent question. The 12.5% is actually a variable number. It can be as low as 8%, or it can go up to 12.5%. What we want to do on the downside is we want to make sure that we protect ourselves from a serious loss, but at the same time, we give ourselves room to bounce back when the fund, the selling of one fund manager can be an opportunity for others. So the 12.5% is at its, because the market's volatile right now, it's at its lowest point. It can be up as high as 8%. Hope that answers your question. Oh, we have a skeptic. It says, I'm skeptical. How can you pick nothing but winners? Well, the truth is we don't. We often lose on one or two in a portfolio of 10. We don't need all of them to make money to get our 2.5% or to get our 2 wins. But 1 or 2 losses is only 10 or 20% of the whole portfolio, and we can make up for those losses with the other 80%. So no, we don't win all the time, but we win more often than most. Oh, there's a good question. Someone wants to know, I don't understand why funds can't copy your system. Yeah, that's a really good question. Their problem is size. They have to invest so much in an individual stock and so much in a multitude of stocks that they get a problem in that if they trade quickly, they'll crater the price. So it can take a fund 2 weeks of careful trading to divest themselves completely of one single stock. So with these massive positions, they just can't trade actively the way we do. So right off the bat, they just can't trade the same way we can. Okay, what's it say here? Oh, I get this one often, actually. If we all buy the same 10 stocks at the same time, won't that affect the price? If we were 10 mutual funds with $1 trillion each, buying at the same time, it absolutely would affect price. But the fact is the funds are so big and the trading volumes are so large that with us all coming in the market with our 10 stocks, it doesn't affect a thing. So think of a whale with a few pilot fish floating around it. The funds of the whale, we're the pilot fish. We don't affect anything. But very good question. Anybody else? Oh. Question says, you mentioned a number of system improvements made over the past 5 years. What were they? Okay. Well, some of them are quite technical, so I won't go into those, but okay, let me give you an example of a couple that are easier to understand. First, when we started off our system, we had a 3% rule for portfolio selling. So we had to be up 3% before we would sell a portfolio. By doing a bunch of research, we realized that, in fact, if we drop that threshold to 2.5%, we'd take a lot more profits a lot quicker and roll over our portfolios and make money. And that made a big difference in terms of overall system returns. We just trading in our system, trading faster is better. More portfolios is better. More returns, more small returns. And a second improvement was actually made fairly recently, within the last year, and that was, while our stock selection algorithms focus not just on the stock but also its industry, what we weren't doing as much of is looking at whether that particular industry or sub-industry was rising in terms of favor or falling out of favor. We've now put measurements in, and we do a final scan, add those results to our selections, and change stocks because of that. As a result, today we end up with 10 stocks that pretty much always are in industries that are either rising in favor or neutral, but not falling. And that's made a difference in our returns. Excuse me. Any more questions? Excuse me. Yeah, here's a good question. Yeah, people don't understand this sometimes. The question is, I don't understand how you can avoid quarterly earnings reports. If all companies report quarterly, how is it avoidable? Yes, all public companies have to report earnings quarterly, but they don't have to report at the same time. They're on different cycles. So what tends to happen is every month, a different set of companies is reporting. So what we do is, in our selection process, we automatically eliminate a stock from being selected if it's got an earnings report due in the next 20 trading days. In other words, within our trading window. So we just will not pick a stock if its earnings are coming up soon. And we actually didn't do that in the first year, in 2016. That was one of our improvements. And again, that's made it, avoiding risk is always good. I think that's probably it for questions. So I'm going to say thank you very much for your time and attention. I hope you found this interesting, and I hope you found it profitable. Thank you.